Time to check in with Amanda Lang. She is, of course, business reporter with BNN Bloomberg, host of Taking Stock, which you can, by the way, hear across the Iheart Radio network. So, Amanda, I want to start with some Canadian numbers today. Real GDP, 0.3% growth in April, 0.1% in May. It seems to me we've talked GDP before. These numbers, how do we look at them? And is the question really to be asked, what's going on?
Yeah, I mean, we knew that the economy was going to be weak. We're tracking for 1.7% growth annualized in the second quarter, but that's actually, believe it or not, above what economists and the Bank of Canada were looking for. So it's weak, but it could have been weaker, I guess is how we're going to look at it. It kind of feeds into the narrative that the bank has room to keep lowering rates if that's what they decide to do. Whether the recent inflation data gives them that potential, I don't know. But certainly this GDP number could mean we could see unemployment tick higher and, business weakness continue.
So you never want to hear that, GDP numbers necessarily are going down. You want to know that an economy is running as efficiently as it can. I know much has been made about this by the opposition, talking about Canada's weak GDP numbers. What turns this kind of stuff around? I mean, theoretically.
I mean, what really turns it around is consumption, right? So business investment, but at the end of the day, it's consumers buying things. So growth is, expansion comes from people acquiring things, whether that's businesses or individuals. One of the problems we have, and I know, we've talked about it, we're going to keep talking about it, is we don't have an efficient economy. That's a good word to use. Our productivity is the way we would measure that. Weak productivity means we're getting less bang for our buck. So hours worked don't turn into the same kind of economic clout that other economies have. One big reason for that is pure and simply the fact that we've let our housing market become the largest sector of our economy. Literally, it is the biggest component of GDP, and it's not a productive one. It doesn't actually create benefits beyond the immediate person buying or the immediate person selling. So, obviously there's a whole supporting cast of industries around it, but even that is what we would call unproductive investments. So there was actually a recent research done suggesting that until we get housing down as a share of our economy and manufacturing, back up, we are going to see this kind of lackluster performance.
I saw some numbers, I think actually just yesterday. Now, these are in the U.S., but I don't know, maybe a harbinger here. The idea that people now, they've done some data, that are starting to now put off significant purchases. And when I say significant, I don't mean a home, I mean like a new car. And it's starting to happen more and more now. That does not augur well for what may be happening here, I would think.
No, that's very true. And so we see that we do see certainly interest rate sensitive industries. So as people consider, especially in Canada, because we do have the big mortgage resets coming, right? So 2025 and 2026 are huge years for mortgage resets because we had record new mortgages in 20 and 21. And what will happen, of course, is that people are already mentally preparing for higher costs ahead. So they are going to put off other, especially rate-sensitive purchases. Cars will be one. Anything where the interest rate is affecting their ability to manage the payments. When we see those kind of sort of so-called durable goods, that will be household items as well. That is a natural part of the cycle when we do see higher rates. That should change. I'll tell you one thing that could make us all nervous, and that is we're seeing service sector inflation. That happened in the U.S. We're starting to see it in Canada. That's a problem because that services, of course, is one thing where we would hope we would continue to see growth and strength. And if that starts to hurt people, then that'll drop off too.
So if I could tie into that as well. So these are Canadians now looking, you mentioned the mortgage situation, and that's about to, we think, get worse. Even if there is a lowering of the Bank of Canada rate, it's not going to have a huge impact, at least not at the beginning. So we have a new report from Vanguard that shows we're overdoing it when it comes to investing for our retirements. Why? Because apparently Canadian investment portfolios are 18 times overweight in Canadian holdings, which is interesting. You'd think that'd be a smart thing, more often than not a safe way to go. When you look at the U.S., their markets continue. I mean, they're on fire. I think they returned something like 15% in the first part of this year, yet Canadian stocks doing exactly the opposite. So what has to happen there? I mean, Canadians are told, hey, let's invest in our own companies. Let's invest in stocks here, but the returns simply have not been there.
Yeah, and this might be a bit of a holdover to rules that used to mean that we couldn't invest outside of this country. Only 30% of our RSP was allowed to be international. That's no longer the case. You can put your money wherever you like in the world. The biggest reason not to put it all in Canada, and I like the idea of investing here and supporting our businesses. The problem is most of us will do that through a kind of a broad exposure to the market, and our market isn't very broad. It's very weighted towards banks and energy companies, two super important sectors, and yes, you want exposure to both, but you don't want that to be, a massive half of your portfolio, which is basically what Canadians have. Whereas now in the U.S., they have a similar problem. Let's agree that although their stock market has done well, it's also only 5 stocks, and they're all tech stocks. So I would say yes, diversify internationally for sure, but also think about the fact that you're then exposed to tech stocks. So here you get banking and oil, there you get tech. Maybe you want to think about how to get some other components into your portfolio. But beyond Canada is always a good thing. And it's probably because of what we were just talking about. Our salaries tend to be tied to Canada. Our homes are tied to Canada. Our investments should probably be diversified to some other economy.
So if I could just kind of take this idea where, we're seeing spending beginning to slow, at least south of the border. Let's say that begins to happen here and we begin to notice that it's actually happening here. What does that do to the Bank of Canada in terms of deciding to lower rates? Does it mean to them that, hey, people are finally starting to spend less? Now we can bring down rates? What does it mean, do you think?
I think it's in keeping with what they expected to have happen. I think the bank is probably unsurprised by anything they're seeing. And again, they were looking for weaker economic growth right now. So we're surprising them on the upside. And we are going to continue to see the effects of these high rates. We know there's a lag effect, and it can be up to 18 months before a change in rates works its way through the whole economy. So even that lower rate we just saw, we're not really seeing the effect except psychologically, or there may be some media purchases or lines of credit that were affected. But to get really into our whole economic system takes a long time. I think the bank is on a lowering path now. And the biggest impediment is going to be what the U.S. does, because we can't get too far off what they're up to. And if they don't lower, we're really threatening our Canadian dollar by lowering too much. But I would not be shocked to see the bank. They might pause in July, but I think most people expect them to keep lowering through the fall.
Okay, last theoretical question. Given what's going on politically now, rumors, of course, of Justin Trudeau maybe walking away, stepping down from the Liberal Party. Economically, when people are looking to invest in this country, how much of an impact does that have? What's going on politically?
Very little. I mean, the good news for Canadians is we have a super, super stable system. We have super stable political officials. It doesn't really matter. I'm going to, not to be rude, but it doesn't really matter who's occupying, our parliament or 24 Sussex. Everything will be fine. There's not going to be any massive dramatic change. And I say that with some smugness because that cannot be said of other countries, some of them quite close to our borders. So, it's been a long time since currency markets looked at anything except our debt in our country. Now, that's one thing you might say. Could we get back to a place that we did in the 1980s where people were worried about our ability to pay back our debt? Yeah, we could. We should be careful, but we're nowhere near that either.
I'm going to remember those words, Amanda. Everything will be fine. I'm going to keep that.
Everything's
just
fine.
in case. Have a great weekend. Thank you so much.
Thanks, you do.